Hello, very good afternoon to all, and welcome back to today's Daily Dose of Market Insights. And welcome to a brand new week ahead. And I hope that you all have a great, restful weekend. All right, very good afternoon to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 10th of February 2025. So let's quickly take a look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future. This advertisement has not been reviewed by the Monetary Authority of Singapore. Right, so as usual, let's have a quick recap what has taken shape over the weekend last Friday in terms of the movement of the key cross asset classes, relevant economic data and events that has taken shape. And it is rather important in this aspect. Why? Because we know that this year will be likely to be quite volatile due to the unpredictable nature of US President Trump in implementing his trade tariffs policy, which has playback again over the weekend. So let me start with last Friday movement on the major US stock market first. All right. So if you look at last Friday movement on the major US stock market, it was rather bearish over here. It was rather bearish. So what I could see is that price action on the S&P 500 open high, but can't manage to maintain the opening momentum and starts to trade towards the lower part of the session throughout the entire last Friday US session. That means i.e. it closed near the last Friday US session low. Similar for the Nasdaq 100 as well. All right, and in fact and that was also being seen on the Dow Jones Industrial Average. All right, open high, then thereafter it can't actually maintain that momentum and it just trade all the way down towards the end of the US session. So what I could see over here is that among the four major US stock indices, the weakest hit was the Nasdaq 100. So that actually came in within our expectation. Why? Because if you recall, on last Friday we have a neutrality stance, intraday neutrality stance on the Nasdaq 100 because of the inherent not so rosy positive momentum that was depicted on the technical chart, on the short-term technical chart of the Nasdaq 100. Right, so later I'll cover also one fundamental and intermarket dynamics to explain to you guys why the very clear underperformance of the Nasdaq 100 that is taking shape right now. All right, and also on last Friday, we also start to see dollar strength coming back into the picture as well. So for the US dollar, what you could see over here is that initially the dollar sold off. Right, the dollar sold off upon the release of the non-farm payroll data, which also came in within our expectation because we do have a slight bullish bias on the euro dollar and the sterling dollar. So both hit our first short-term resistance level before the euro and the sterling sold off against the dollar throughout the remaining part of the US session over here. So what we could see over here at this point in time, the dollar seems to be gaining a bit of traction, but however, the one particular outlier is the dollar yen. So this dollar yen over here, yes, is trying to actually recover, but the dollar recovered much as a slower speed versus other major currency. And one of the reasons why the dollar yen is recovering at a slower speed on a very short-term basis is due to the fact that we know that trade tariffs lead to global trade tension. And this global trade tension is potentially risk-off in nature, and being risk-off in nature, that potentially could benefit the yen as well. And do not forget over here is that the Bank of Japan is still now embarking a normalization monetary policy. That means, i.e., market is expecting potentially 2 more interest rate hikes. Pardon me. Potentially, I repeat, market is now still expecting potentially 2 more interest rate hike from Bank of Japan before 2025 ends. That means, i.e., right now the short-term Bank of Japan key policy interest rate recently they just increased by 25 basis point to bring it to 0.5%. Now market expecting 2 more hikes from BOJ potentially before 2025 ends. The short-term interest rate, policy rate in Japan may rise further to 1%. So that actually also explain why the dollar yen is not rebounding so fast as compared to the rest of the other dollar major pair against the other major currency, as depicted by this 5-day rolling performance chart of the US dollar against the major currency as of now we are speaking. And also one of the reasons why the dollar also strengthened on last Friday is ahead of that Trump new tariffs plan coming out from Trump. Later I'll share with you all, is because of a rather, I would say that it's a not so really that bad non-farm payroll data as a whole. So if you look at this economic calendar, let me share with you guys. So we know that the headline non-farm payroll was weaker than expected. Market expecting 170K, but it only came in at 143K. But however, the unemployment rate ticked down slightly lower to 4%, which is actually indicating to us that the labor market hasn't deteriorated yet that badly. All right. So one of the major reasons before the Trump new tariff plans news flow come in was that rather weak U.S. confidence data. That is the primary driver of, number one, the dollar strength bouncing back in the later half of the US session, and also causes the major US stock indices to turn weak in the once it hit into the second half of last Friday US session. So you look at this Michigan consumer sentiment is preliminary, is flash. So this is survey based. So anything that is survey based tends to actually pierce into the mindset of the targeted audience, which has a kind of leading element. So this is considered as leading economic indicator. That means they are trying to pierce into what is the targeted respondents expectation in the near future, and as well as for the longer term about the spending behavior. So based on this latest consumer sentiment flash data for the month of February, it actually came down below expectation. Market is expecting 71.1, it only hit 67.8. So that represents a softness in consumer sentiment. Once you mean softness in consumer sentiments, very likely it will lead to what I call less consumer spending and less services activity in the US. So we know that services activity in the US that comprises of consumer spending represents 3/4 of US economic growth in the last 20 years or so. And during this consumer sentiment survey as conducted by University of Michigan, they also asked correspondent what will be their inflation expectation will be 5 years down the road and 1 year down the road. So Michigan inflation expectation 1 year down the road for the month of February, market expecting inflation to actually rise to 4.3% from previously surveyed result for the month of January at 3.3%. So if you look at the trend of the 1 year inflation expectation based on survey-based data, as depicted by the latest University of Michigan survey flash results, we see that inflation expectation 1 year down the road has slowly ticked upwards. And in fact, last we call it Friday's we call it fair finding is actually the highest since May 2008. All right. So what you could see is a rapid we call it pricing or rapid expectation that 1 year down the road, inflation expectation may rise at a very steep rate. So that actually indicate to us potentially market is now looking for some kind of stagflation risk coming into the picture. Why stagflation? Number one, stagflation represent slowdown in economic growth, but in the meantime higher inflation rate. So this slowdown in economic growth primarily driven from the confidence side of the mentality of market participants. Very likely it could be due to the uncertainty of trade tariffs, and these trade tariffs could lead to what I call tit for tat measures by US major trading partners, not only impacting China but rather EU and the other major trading partners like Canada, Mexico, and potentially even some of our Southeast Asia export country that could actually unleash onto US if Trump were to actually push through his rather hawkish trade tariffs policy to extract as much consensus or as much gain from this country that will actually Trump hope to actually shift this country we call it manufacturing hub all the way back to US, okay, until he gets that aim. If not, potentially this tit for tat tariffs will actually slow down international trade, slowing down international trade, clamp down global economic growth, and meanwhile also ignite inflationary pressure as well. So that is what the survey data that is showing on last Friday based on the preliminary finding of the University Michigan survey both on the consumer sentiment side as well as inflationary expectation side. So net overall, it has a negative feedback loop impact on the stock market because the dollar strength remains on a rather firm footing, yes, on last Friday. And also because of this stagflation narrative that has come back into the picture, it starts to change the dial on the market expectation for future interest rate cut by the US Federal Reserve for 2025 as depicted by the CME Fed Watch 2. So I don't want to explain again what is this CME Fed Watch 2 about for those who followed my daily dose on a frequent basis. It's a free tool where we are able to get a probability as calculated by the CME exchange Fed Watch 2 taken from data from the Fed Funds futures market. So what you could see is still very high odds of 93% that the next coming FOMC meeting, which is on the 19th of March, will be unchanged. That means the Fed will not hike or will not cut rates, holding rates steady at 4.25% and 4.5%. So that is the Fed short-term overnight policy rate. But what's interesting in the aggregated tab, where they actually compile the future dated Fed funds futures market, what market expecting is right now based on the latest trading data. This latest trading data as of 6 to 7 hours ago. The next high chance of interest rate cut potentially will come into the summer months of 2025 by looking at this probability, the one that is shaded in light blue over here. 78% chance that it may come in 30th of July, September as well. 17th of September, 94% chance. So market is expecting potentially one more interest rate cut, but it will only come in either July or the September month of this year by bringing down the Fed funds rate lower by 25 basis points to 4% to 4.25%. And last week, I did highlight that there's still a high chance, about 60%, that the Fed may cut again. That means the second cut in 2025 to come in before 2025 ends. That means on the 10th of December 2025 FOMC meeting. But however, this latest odds now has been reduced from 60% to only 46%. That means based on the current so-called pricing of the Fed Funds futures market as being compiled by the CME Fed Watch 2, market participants in the Fed Funds futures market only expecting one interest rate cut this year due to the potential stagflationary narrative that is coming back into the forefront of the radar of the market participants towards the US economy. All right, and they also expect 2026 to remain, the next cut may come in only in 2026, somewhere around March 18 March 2026, the next interest rate cut. Then thereafter, after March 2026, they do expect the Fed to actually remain on hold throughout the entire year of 2026. So what we could see over here is that the last year dovish pivot now has started to switch to more of a normalization pivot, very less dovish, and potentially if Trump trade tariff starts to turn more hawkish and market expecting inflation expectation to tick up much higher down the road, potentially even this interest rate cut that market has portrayed for the months of June to portrayed in the month of July to September this year may also get evaporated as well. Net effect potentially long term, we may from a medium term perspective, that means from the multi-week to multi-month perspective, is actually still supporting a dollar strength from a medium term and a major term time horizon. That means multi-week to multi-month. Yes, intraday we may see this wild swing here and there, which I try to explain during my daily dose of market insight every day. Right, and also the impact of this global trade tension and as well as stagflationary risk scenario continues to see this upward push in gold price. Okay, because gold tends to also benefit in uncertainty, and as well we call it uncertainty in terms of because of the trade, we call it trade international trade relationship. And right now we have that stagflationary risk environment coming back into picture that benefit the current short-term, medium-term, and major uptrending phase of gold XAU/USD. So later I'll touch on the key levels to watch again on gold when we cover the short-term intraday technical outlook. All right. So now let me now share with you fundamental and intermarket dynamics that is more pertaining to the US stock market. All right, so this particular instant I'll share with you guys is this 1 month rolling performance as of now we are speaking by plotting the the particular four major US stock indices. The one in purple is the US Wall Street 30, which is Dow Jones. The one in dark green over here is the Russell 2000. Light blue is the S&P 500, and the green color is the Nasdaq 100. So if you look at the 1 month rolling performance, the worst performing right now among the US major stock indices is the Nasdaq 100. Why? Because Nasdaq 100 consists of those mega cap technology stocks, Amazon, Apple, especially Apple. Apple do have a lot of revenue that is internationally driven, and also not even Apple, even Amazon as well. And we have Tesla as well, which is a part of these mega cap stocks as well. So most of these mega cap, we call it revenue, they are internationally driven rather than domestically driven. So being international revenue, if they didn't have their proper hedging, FX hedging strategy in place, with the dollar strengthening, when they convert back the foreign revenue inflow back to US revenue inflow, over here potentially they may see lesser inflow. So that also causes the weakness on the Nasdaq 100. And we do not forget, Nasdaq 100 is trading at the higher valuation in the last 5 to 20 years, and also the higher valuation against the rest of the world and against the other three major US stock indices. And also right now, 2 to 3 years back, the outperformance of Nasdaq 100 within the US stock market and against the rest of the world have been driven by this AI driven productivity gains. So this AI driven productivity gains has been centered on the top AI related companies, like Nvidia is one of them, AMD. So after the what I call it, the news or the emergence news of China AI startup DeepSeek cutting edge capability. So because of this DeepSeek cutting edge ability that is almost on par with OpenAI, but most importantly, DeepSeek managed to reduce the operational cost of running their AI capabilities by not having the best premium GPU chips. All right, which market now is actually looking for Nvidia, which is being priced at a huge premium against other kind of GPU chips. So market participants right now has begun to reprice that, hey, perhaps Nvidia doesn't need to be priced so expensive as it right now in terms of Nvidia growth story, and also in terms it has a knock-on effect on other US semiconductor stocks as well. And that causes a negative feedback loop into the Nasdaq 100, given the fact that the Nasdaq 100 in the last 2 years or so, especially last year, is being driven by this ongoing AI related play, which involves the key semiconductor stock and definitely also spill over to the mega cap technology stocks like Microsoft will be one of them, and as well as Meta, and we have this Apple as well, which wants to actually develop its own AI capabilities into the smartphone, Apple smartphone. So market now has a so-called a realization that, hey, perhaps after the DeepSeek cutting edge capability that has operate as a lower fraction of cost compared to US AI model, which is run the premium of OpenAI, the whole world may not need so much high premium Nvidia type of GPU semiconductor related chips. So that actually explains the sell-off in the US major stock indices, especially the Nasdaq 100, whereas China proxy related play like the Hong Kong 33 clearly showing outperformance by rallying close to 11%. And this Hong Kong 33, which is Hang Seng, and the Hang Seng Tech Index, which OANDA doesn't have in our platform. You guys can Google, called the HS Tech Index, that comprises of H shares that are related to China semiconductor industry like SMIC also, and even Alibaba as well, who has claimed to actually who has announced that he has also developed a cutting edge AI model capability that actually causes the Hang Seng benchmark stock indices to actually outperform the US major stock indices as we are speaking. And this outperformance may continue based on this trend from a medium term perspective. That means we're talking about from a multi-week perspective, maximum multi-month. All right, so this is the intermarket and fundamental dynamics I want to share with you all pertaining to the major US stock indices. All right, so with that, now let us now have a deep dive into the intraday technical outlook on the broad-based cross asset classes, starting with the FX market first. But before that, as usual, let me expand my screen so that you guys could see a better clarity on the key levels that I'm about to share with you guys. So let us start with the European currency against the dollar, which is the euro dollar. All right. So the euro dollar over here. So the euro dollar initially on Friday we were bullish. Okay, looking for a push up. The push up hit our first resistance before selling off and broke below the 20-day moving average again, which represent that there is some form of short-term intraday bearishness that has flowed back into the euro dollar pair. And with that, we will flip to a intraday bearish bias, but this intraday bearish bias seems to be taken on the form of a sideways rangy configuration that is in place since the low of 13th of January. So it may be trading in this kind of minor symmetrical range triangle. Over here, what we could see, this could be a minor symmetrical triangle range. Okay, let me draw the upper boundary for you guys to see. Okay, over here it got rejected. So upper boundary, lower boundary. So notice that these two line over here is moving in the opposite direction. One is sloping downwards, the other is sloping upwards. So this, if you look at it over here, is potentially is a emerging kind of minor symmetrical triangle range configuration. And by breaking below the 20-day moving average on the euro dollar, potentially it may start to float downwards towards the lower limit of this symmetrical triangle range configuration that may be evolving for the price action on the euro dollar on its hourly chart. All right, so with that, I'll be using 1.0360 as my short-term pivotal resistance for today. Flip to a intraday bearish bias within this minor symmetrical triangle range resistance. Next near-term support level to watch will be 1.0270, followed by a breakdown below 1.0270, exposes 1.0220 slash 1.0190, which is the area of that lower boundary of this ongoing symmetrical triangle range configuration. Only hourly close up and the push up above 1.0360 will negate today's intraday bearish bias to see a squeeze up to retest last Friday swing high area, expose non-farm payroll data release at 1.0405. We also correspond to the 50-day moving average acting as a resistance, and as well as the upper limit of this minor symmetrical triangle range configuration. All right, so that's for the euro dollar. Flipping to a intraday bearish bias using 1.0360 as my short-term pivotal resistance level for the euro dollar to potentially continue to see this minor symmetrical triangle range configuration to play out for today. All right, so that's for the euro dollar. Turning our attention next will be the sterling dollar. So the sterling dollar also rebounded as expected, hit our first resistance zone at 1.2460 slash 2490, which the 50-day moving average got rejected again, and now looking to retest the 20-day moving average, and as well as the support that was being seen on last Thursday exposed Bank of England monetary policy decision outcome. So with that, we given that rejection of the 50-day moving average, I'll be using the 50-day moving average as my as my short-term pivotal resistance area for today, 1.2460 slash 1.2490. Flip to a intraday bearish bias for the sterling dollar, a breakdown below 1.2375 in the European session thereafter potentially open up scope for a potential further slide to revisit 1.2240 next, which is a very clear congestion area of swing low of 3rd of February that managed to survive upon hitting the former congestion area of 17th of January and 21st of January this year. Okay, so very likely it could be also be evolving in this kind of minor range configuration as well. So it's something like a sideways range configuration since the high of 27th of January, and the lower limit of that sideways range is at 1.2240. All right, so only an hourly close above and a push up above 1.2490 will invalidate today's intraday bearish bias to see a squeeze up to revisit the next resistance zone at 1.2580 slash 1.2610, which is the minor swing high area of 30th of December and 7th of January this year. So i.e. Given the rejection of the 50-day moving average on last Friday, we'll be using 1.2460 slash 2490 short-term pivotal resistance level. We'll flip to a intraday bearish bias within a short-term sideways range configuration on the sterling dollar for today. Okay, onward next will be the Asia Pacific currency, which is the Aussie dollar. So the Aussie dollar last Friday we were bearish, and the bearish buyers hit our first support level at 62.40/62.25. So with that, we will have a tightened key short-term pivotal resistance for today for a better risk management perspective. 62.95, which is the 50-day moving average that got rejected one time and two times since last week over here. So 6295 will be my short-term pivotal resistance for today. We will still have that intraday bearish bias on the Aussie dollar. A breakdown below 62.25 exposes the next support level at 61.65, which correspond to this congestion area here of 30th of January and 4th of February. And if you do the Fibo retracement of this last swing rebound or last push, intraday, last minor rebound from the low of 3rd of February all the way up to last Friday high, is correspond to the golden ratio as well of 61.8. All right. However, only a push up and hourly close above 62.95 will negate this intraday bearish bias to see a squeeze up to revisit the medium term pivotal resistance level at 63.30. So i.e. for today, we will have a tightened key short term pivotal resistance on the Aussie dollar to maintain the intraday bearish bias at 62.95 short term pivotal resistance. So that's for the Aussie dollar. Lastly will be the dollar yen. So the dollar yen continues to bounce up from our short-term pivotal support level that we highlighted 150.95/70, tested twice and survived. So we continue to look for that ongoing minor mean reversion rebound to take shape. Resistance zone to highlight, the first one will only be at 152.90/153.25 level, which is also the 200-day moving average that managed to keep it resistance since the breakdown of it on last Wednesday. Only a breakout above 153.25 may potentially see the extension of this minor mean reversion rebound to expose the next near-term resistance level at 154.10. That means, i.e., instead of be so ambitious to hit 154.10, it got to clear above 153.25 first over here. And bear in mind, fundamentally, fundamental factors, which I explained to you all earlier at the start of my today's daily dose, doesn't justify for a much more strengthening of the dollar yen. All right, so we're only looking forward a kind of a potential mean reversion rebound on a minor scale from a technical analysis perspective as well, using 150.95/70 as my short-term pivotal support to maintain this view. But first resistance to watch out for will be 152.90/153.25. However, if price action suddenly during the European session and thereafter stretching into the start of the US session starts to break down below 150.70, then today's intraday bullish bias for that mean reversion rebound scenario leg will be invalidated to see the continuation of the impulsive downmove sequence, exposing the next near-term support level at 149.70/30, which is the 1.236 Fibo extension, and as well as the minor swing low area of 5th of December and 9th of December last year. All right, so that's for the dollar yen. And now moving on next will be the short-term intraday technical outlook on the major stock indices, starting with the Hong Kong 33. So for the Hong Kong 33, we do have a bullish bias since last week, and this bullish bias is almost coming very close to our short resistance level already at 21,710/21,800, which is the 1.236 Fibo extension, and as well as the minus this minor congestion area here of 3rd of October. Right, so we already hit this resistance level. Okay, so with that, you're also coming to the top of this channel as well. Okay, top of the ascending channel, and with that, the hourly RSI now has starts to trace up a bearish divergence. Okay, what I could see, price action go higher, but the RSI has starts to shape a lower high. Okay, higher high in price action, lower high in RSI. So representing there could be a risk of a minor mean reversion decline. That means this kind of momentum, upside momentum appears to be overstretched. So using 21,800 level as my short-term pivotal resistance level, we'll flip to a intraday bearish bias for the Hong Kong 33, representing the Hang Seng Index, for a potential minor mean reversion rebound scenario to take shape within its short-term uptrend phase that is still intact. Why? Because it's still trading above the 20 and the 50-day moving average. Near-term support level to watch for today will be at 20,980 / 20,830 as we head into the European session and US session thereafter today. Only an hourly close above 21,800 will invalidate today's intraday bearish bias and also invalidate the today's intraday potential minor mean reversion decline scenario to see the continuation of its impulsive up move towards the next resistance level at 22,000 / 22,050. Above 22,050 takes us up to the 1.618 Fibo extension level at 22,470, which also correspond to the minor congestion area of 3rd of October and 4th of October last year. All right, so that's for the Hong Kong 33. Due to this bearish divergence that's been depicted on the hourly RSI, we will use 21,800 short-term pivotal resistance for today, flip to a intraday bearish bias for a potential minor mean reversion decline scenario. Within is still a short-term uptrend phase that is still intact. Right, so that's for the Hong Kong 33. Turning our attention will be the Japan 225, represent the Nikkei 225. So Nikkei 225 plummeted as expected, hit our first support level that we had last Friday, and now is trying to rebound back up and showing signs of exhaustion by looking at this series of small body little candle that is being formed at the upper limit of this potential descending channel that could be in place since the high of 24th of January this year. So no change. First resistance level will be at 39,000. I don't put it so tight as my short-term pivotal resistance level. Short-term pivotal resistance levels will be still using 39,310. So just in case of any spike up, all right. So 39,310 short-term pivotal resistance level will still maintain that intraday bearish bias. First support level to watch remains unchanged at 38,380. Only a breakdown below 38,380 may expose the next short-term support level at 38,140, which is the minor swing low area of 13th of January and 17th of January. Only a push up with an hourly close above 39,310 will invalidate today's intraday bearish bias to see a squeeze up to revisit the next intermediate resistance zone of 39,710, 39,830, which is the minor swing high area of 31st of January and the former swing low area of 23rd of January and 23rd of January. All right, i.e. still using 39,310 to maintain the short-term intraday bearish bias, 39,310 short-term pivotal resistance to maintain that short-term intraday bias on the Japan 225. All right, onward next will be the German 30. So the German 30 last Friday hit the first resistance, then thereafter it tried to shape that pullback over here. So what we could see is the levels still remains unchanged. Hourly RSI seems to be turning positive right now after almost hitting the oversold level and starts to inch up a higher low as we are speaking right now. So still no change as the European session may potentially opens up in the next 1.5 hours or so, still using 21,640 as my short-term pivotal support level. Maintain that intraday bullish bias on the German 30. First resistance level to surpass 21,960 / 21,990. Above it potentially sees 22,160, which is the Fibo extension level, and as well as the upper limit of this ascending channel that is in place since 19th of November last year. Only push down and an hourly close below 21,640 short-term pivotal support level will invalidate today's intraday bullish bias on the German 30 to kickstart a mean reversion decline scenario, a minor one, potentially revisiting the next near-term support level at 21,390, maximum 21,100, which also correspond in between this level of 21,390 and 21,100 correspond in between the rising 20-day moving average. Right, so i.e. still using 21,640 short-term pivotal support level to maintain today's intraday potential bullish bias on the German 30, i.e. which is the German DAX. Onwards next will be the US stock indices, starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average this morning, it came down, tested our short-term pivotal support level that we have on last Friday and managed to stage a bounce. We also correspond to the rising 20-day moving average as well. So it seems to us that since the high of 31st of January this year, it has been trapped in this kind of minor sideways range configuration since the last 1.5 weeks. That means, i.e., it may start to evolve in a minor symmetrical triangle range configuration. And today's price action managed to stage a bounce right off the 20-day moving average and also the minor range configuration, and as well as last week or last Friday, kind of a predefined short-term pivotal support that we already highlighted at 44,250. And right now, the hourly RSI has started to shape a higher low as well after hitting a oversold reading or oversold condition reading in today's Asia session. So with that, still using 44,250 as my short-term pivotal support level, we will still maintain the intraday bearish bias, but now the intraday bearish bias is not so bullish as before. It will be more likely be in a minor symmetrical triangle range configuration and maximum towards the upper limit of this minor symmetrical triangle range configuration at 44,840 for today. All right, only a breakout above 44,840 potentially may see more traction to expose the next near-term resistance level at 44,090/100 level, and above it sees the current all-time high area at 45,500/700. Only an hourly close below 44,240 and a breakdown below it invalidate today's intraday bullish bias and see a potential breakdown towards the next near-term support level at 43,730/43,600, which also correspond to the 50-day moving average as well. Okay, so that's for the US Wall Street 30. Now, turning our attention next will be the higher beta Nasdaq 100. So the Nasdaq 100 last Friday we were neutral. If you look at the technical configuration, it breaks down below this minor ascending trend line from the low of 3rd of February. So what I could do over here is that I'll be using last Friday minor swing high area at 21,845/945, which is slightly above it over here, which is this minor swing high. So this will be my short-term pivotal resistance zone. As long as this resistance zone didn't surpass to the upside, potentially the Nasdaq 100 may shape another so-called minor mean reversion decline scenario again. First support level to watch will be 21,340. That was close to last Friday low. Below this level exposes 21,125 next. Okay, only a push up with hourly close above 21,945 will invalidate today's intraday mean reversion bearish decline bias to see a squeeze up to retest the current all-time high level at 22,135 that was printed earlier in December last year. Okay, December last year. All right, so that's for the Nasdaq 100. Now, turning our focus now will be on the commodities market, starting with gold XAU/USD. So for gold XAU/USD continues to shape that bullish bias over here. So right now it's revisiting the resistance level that was tested on last Friday at 28,830/890. Okay, all right. So but it started to shape a higher low, and this higher low managed to survive right exactly after the retest of the former upper boundary of this minor ascending channel that I previously drew from the low of 31st of December, indicating some form of bullish acceleration in trend for gold XAU/USD. So with that, we will have a slightly tightened short-term pivotal support level for today. So I will tighten it to 28,045 level. Okay, let me copy this, put it in writing. Okay, let me delete this. Okay, let me delete this as well. Okay, let me just give a couple of minutes to actually come to this level here. Okay, hopefully it runs soon, sir. Okay, let me say that first, 28,045. That will be my new Titan short-term pivotal resistance, pivotal support level for today. Okay, hopefully it managed to. Oh gosh, what's going on? Okay. Okay, it's not allowing me to change. Okay, maybe I just put it in writing. Hopefully it's able to do it. Okay, let me put it in writing. Okay, good. 28,045. So this will be my short-term pivot. Okay, short-term pivotal support level, Titan 1, 28,045 for today. Maintain that intraday bullish bias on gold XAU/USD, given that it's forming a kind of bullish acceleration above 2,890, exposes the next near-term resistance level at 2,009/200912. Above this level, potentially sees the next resistance coming in, another Fibo extension cluster. Notice that it's very close to 2009, 2003, 2940, 2945. Okay, let me put it up for you guys to see. Okay, let me tidy up everything. 2,945, 2,940/945. Okay. Okay, to sum it up, potential bullish acceleration in place with a tightened key short-term pivotal support level for gold XAU/USD for today, 2,845. Maintain, is this level managed to hold? Maintain that intraday bullish bias. Next resistance level to watch, 2,909/2,912. Above 2,912 exposes 2,940/2,945. Only an hourly close below 2,845 negates this bullish tone, and for gold XAU/USD to kickstart a minor mean reversion decline scenario, exposing the next support zone at 2,812, 2,795, which correspond to the lower limit of this ascending channel in place since the low of 31st of December. So that's for gold XAU/USD. And lastly, now let us focus on the oil market, which is the West Texas crude oil. Let me open up the chart. So I think the chart is not on yet, or I accidentally closed it just now. Okay, give me a couple of seconds. Hopefully this chart will be on pretty soon, because as we are speaking, it tends to slow down, because it tends to slow down this trading view. Okay, West Texas crude oil. Okay, so for West Texas crude oil over here, okay, no change on last Friday. It tried to trade sideways. What you could see over here, hit the first support level, come break below it, and push back up again. So still no change, right? We'll be using the 50-day moving average that is acting as the resistance, which is our short-term pivotal resistance that we have on last Friday, 72.70. So as long as 72.70 short-term pivotal resistance is not surpassed, we still maintain that intraday bearish bias on West Texas crude oil as it continues to evolve within this minor descending channel that is in place since the high of 16th of January. Below 71.05 exposes the next near-term support level at 69.80, which is the minor swing low of 27th of December last year. Only a push up and hourly close above 72.70 will invalidate today's intraday bearish bias to see a squeeze up to revisit 74.15. Above 74.15 potentially exposes the next resistance zone at 75.75/76.16, which correspond to the downward sloping 20-day moving average as well. Okay, so that sum up the intraday technical outlook on West Texas crude oil, where we maintain our intraday bearish bias below 72.70 short-term pivotal resistance, and as well as other major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key things to look out for today? So in terms of the economic calendar, today's data, okay, give me a minute. I think, where is, okay, sorry, this is the previous week. Let me put it this week, my apologies. So for today's data over here, the key data to look out for later part, maybe perhaps towards the closing hour of the Hong Kong Stock Exchange. So that's about between 3 p.m. to 4 p.m. Singapore time. Look out for any potential release of China key loan growth data. All right, so we know that loan growth has been lackluster in China because of the lack of consumer sentiment and business sentiment. So they will actually announce it today, but no time is being depicted over here. So something to look out for. At this point, the market is still expecting a low ball number. That means outstanding loan growth is still expecting to actually grow rather lackluster, 73% year on year, below 7.3% year on year, pardon me, below 7.6% year on year in the previous month of December. All right, then that will be the key data to look out for today. And also other key data to look out for other key event to look out for today is more pertaining to Trump's new tariff plan, because over the weekend he actually announced that he is likely to officially issue an executive order today. That means perhaps it will come in as early at the start of the US session. That means we're talking about 9:30 p.m. to 10:30 p.m. Singapore time, to impose 25% tariffs on all steel and aluminium imports heading to the US. So do look out for this potential executive order that could be officially announced at the start of today's US session. Right. So that sum up the daily dose of market insights for today. And with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you very much.